The new chair of the Federal Reserve just used 3 words in a live interview that most financial media completely ignored. Phoenix from the ashes. He did not elaborate. He did not soften it. He described it as a serious framework that serious people inside serious institutions were arguing for during the last major financial crisis. And then he moved on. In that same window, the CFO of BlackRock committed to tokenizing every single one of their exchange-traded funds within 3 to 12 months. And on the same ledger where Morgan, Mastercard, and Ripple just settled the first ever cross-border, cross-bank tokenized U.S. Treasury transaction in history in under 5 seconds. Today, we connect all 3 of these threads. This is XRP verified. Let us get into it. Let us start with Kevin Worsh and why 3 words from a Federal Reserve chair matter more than an entire hour of financial commentary. Worsh was describing a real debate that happened inside serious institutions during the last major financial crisis. He said that some of the most respected voices on the right held the view that the correct response was to let the existing banking system burn down completely, phoenix from the ashes, and allow a new system to emerge from the collapse. He distanced himself from the doctrine, but he left the framework intact in the conversation, and that is the part that matters. Central bankers do not use loose language. They use language as policy. When a sitting Federal Reserve chair publicly acknowledges that a doctrine of controlled financial collapse and system redesign has shelf space inside the conversation that shapes the next financial architecture, that is not a historical reference. That is a signal about where the current conversation is heading. Here is the structural implication that almost no coverage addressed. After a controlled burn, the system that emerges is necessarily smaller. Fewer institutions, more consolidation. Instead of thousands of banks, a handful. And in a system with a handful of banks connected to a digital settlement layer, the design problem changes completely. You cannot onboard 10,000 banks to a digital rail. You can onboard 12. The consolidation is not a side effect of the Phoenix doctrine. It is the precondition. The banks that survive connect directly to the new digital settlement infrastructure. The rest consolidate into them or disappear. And the bridge asset that enables settlement between those surviving institutions across currencies, across borders, in real time, becomes the most critical piece of infrastructure in the new system. Now overlay what BlackRock's CFO said in the same window. Martin Small committed on the record to tokenizing every single one of BlackRock's exchange-traded funds within 3 to 12 months. BlackRock manages $11 trillion in assets. Their ETF suite represents the largest single pool of retail and institutional investment product in the world. Tokenizing every ETF means every one of those products needs to settle somewhere. It needs to clear somewhere. It needs to move between counterparties on a rail that has the regulatory standing, the liquidity history, and the settlement finality to handle that volume without legal exposure. The tokenization is the easy part. The rails are the hard part. And the rails are where this story converges directly with XRP. Because here is what the institutional treasury conversation has actually been for the past 2 years, and it is not what most retail investors think it is. The conversation has not been about which blockchain is technically superior. It has been about which network has already survived 5 years of direct legal scrutiny. Which network has a judicial finding that distinguishes its underlying token from a securities transaction? Which network has a documented 13-year operational history as a settlement bridge between currencies, which is, mechanically, the exact function a consolidated post-reset banking system needs? That filter narrows the field to one asset, and that asset's architects, Brad Garlinghouse, David Schwartz, and Stuart Alderoty, have been building toward this moment not as token promoters, but as infrastructure architects. The thesis was never retail speculation. The thesis was that one day banks would need on-demand liquidity for cross-border settlement at a scale that pre-funded accounts cannot service. Now let us talk about the dollar, because this is the macro context that makes everything we just discussed urgent rather than theoretical. In the year 2000, the US dollar held 70% of global currency reserves. Today that number sits at 56%, the lowest since 1994. 25 years of slow decline. And then Russia invaded Ukraine in 2022, And the United States did something that every non-aligned country on Earth was watching. They froze $600 billion in Russian reserves overnight using SWIFT. $600 billion gone with a single sanction order. And every country that was not already aligned with Washington had the same realization simultaneously. If your reserves can be frozen overnight by the United States, you do not actually own them. You are renting them from the US government. BRICS responded with the most significant monetary challenge to dollar dominance in decades. Brazil, Russia, India, China, and South Africa accelerated their financial independence strategy dramatically. In 2025 alone, they added 663 tons of gold to their reserves, approximately $91 billion. They now hold over 6,000 tons combined. And on October 31st of 2025, they launched a blockchain-based digital currency backed 40% by gold and 60% by a basket of their national currencies, live on a public blockchain. The United States cannot stop it with sanctions, cannot stop it with tariffs, cannot stop it with diplomatic pressure, because it is not a country they are opposing. It is a payment system, and you cannot tariff a payment system. But here is where the US response becomes the most important financial story of the decade, because Larry Fink, CEO of BlackRock, wrote in his 2025 chairman's letter that decentralized finance is an extraordinary innovation that makes markets faster, cheaper, and more transparent, and then acknowledged directly that if investors begin seeing Bitcoin as a safer bet than the dollar, America loses its economic advantage. The CEO of the world's largest asset manager publicly identified the threat. And then the US government responded with the Genius Act, legislation that forces every regulated US stablecoin to be backed 100% by US dollars or short-term US treasuries. Every dollar of stablecoin issued under this law creates demand for US government debt, and US dollar stablecoins currently represent 99% of the entire $318 billion global stablecoin market. When the stablecoin market grows, the dollar wins by default. The Genius Act turned the stablecoin market into a US Treasury demand engine. That is the strategy. Not fighting the blockchain migration, weaponizing it. And Ripple sits at the center of that strategy with RLUSD, their own stablecoin backed one-to-one by US dollars and short-term US treasuries, issued under a New York Department of Financial Services trust charter, already the third largest US regulated stablecoin in the world, hitting $1.26 billion in market cap less than a year after launch. Every dollar of RLUSD minted is forced by law to buy US government debt, and RLUSD is already being used in live production settlement. Since November 2025, Mastercard, WebBank, and Gemini have been using RLUSD on the XRP ledger to settle daily credit card payments. Real Mastercard transactions, real consumers swiping cards in real stores. Settling between WebBank and Mastercard on the XRP ledger in real time, every single day. Now here is the transaction that changes the conversation permanently. On May 6th, Ono Finance, JP Morgan's blockchain platform, Kexis, Mastercard, and Ripple completed the first ever cross-border, cross-bank settlement of tokenized US treasuries on the XRP ledger. The exact US treasuries that the Genius Act forces every stablecoin to hold. JP Morgan and Mastercard, inside the same transaction, settling tokenized sovereign debt instruments on the XRP ledger in under 5 seconds. The same trade through correspondent banking infrastructure takes 1 to 3 business days. This is not a proof of concept. This is not a pilot. This is live production settlement of institutional financial instruments on the XRP ledger, with the 2 most recognizable names in global finance inside the transaction. And the Ripple credit facility to Gemini tells you something about the positioning happening beneath the surface. In July 2025, that credit line was $75 million. By December, it had grown to $150 million. It currently stands at $250 million. Each extension came with tightened conditions tied to holdings and activity thresholds connected to the bridge asset itself. This is not a lending relationship. This is a progressive integration of the largest crypto-native exchange in the United States into the distribution infrastructure of the settlement asset. The facility does not exist unless the infrastructure it is building toward is real and imminent. Let me bring all of this together. Kevin Worsh publicly acknowledged a doctrine of controlled financial system reset and consolidation, and left the framework in the room. BlackRock committed to tokenizing $11 trillion of ETF product within 12 months, and that volume needs rails that can handle it legally, technically, and at scale. The dollar is losing its reserve currency position globally, and the U.S. response is the Genius Act turning stablecoin growth into treasury demand. BRICS launched a blockchain-based alternative to dollar settlement, and the only neutral bridge asset that neither side needs to trust the other side to control is one that has been legally cleared, has a 13-year operational track record, settles in under 5 seconds, and costs cents per transaction. Morgan and Mastercard already proved it works. The infrastructure is not theoretical. It is live. The convergence is not coming. It is already visible in the institutional data, if you know where to look. Stay informed. Stay patient. Stay positioned. If this video gave you real value today, subscribe to XRP Verified. I cover these developments every single day, so you always know what is happening before the rest of the market figures it out. I will see you in the next one.